This is John Lone King, and welcome to my next episode of From Profits to Properties, where I help you with tactics to grow your business profits beyond your wildest dreams, and then I give you strategies in order to convert those profits into long-term wealth through real estate. And whether you're a business owner or whether you're just an individual that's looking to grow your portfolio, you're in the right place. I'm going to give you tactics that you can use in every area of your life and help you to grow your real estate portfolio. So let's dive in. Today, I'm going to talk about something super exciting, recessions. Everyone's excited about recessions, right? No, I'm just kidding. Hey, it's important to look at market cycles. It's important to understand market cycles. And so today I want to talk about the reality of market cycles and how to look at them. Now, I'm recording this in August of 2025. We're in a weird market cycle. We've been in weird market cycles. The truth is every market cycle can be considered a weird market cycle because they're all unique. They rhyme with how the cycles went in the past, but they're all a little bit different. So every single day, both in business and in real estate, you're trying to look at the tea leaves. You're trying to predict the future based on what you're seeing today and how you think that you're going to make the next right move in order to deal with what's happening today and what you think is going to happen tomorrow. So recessions are just a fact of life. There's a saying, and I don't remember where it came from, but it basically says recessions are when, at least X percent, 10% of the population loses their job. I think the saying is, what's the difference between recession and depression? Recessions are when 10% of people lose their job. Depressions are when you lose your job. Okay. Obviously, that's a joke. But the fact is, a recession is a normal part of the cycle where you have an expansion cycle, you have growth, you have a lot of opportunity, and then you have a pullback cycle. And it's kind of the cleansing. It's no different than what we saw in any industry. I'll use the tech industry as an example. The tech industry blew up and everybody was a tech company back in the early 2000s. Then we hit the recession, the tech bubble burst, not the 2008 recession, but the tech bubble burst. And a lot of those companies failed, but the ones that survived were the strongest ones. I was listening to a podcast over this weekend. Yes, there's more podcasts than just mine. So you can listen to other podcasts once you've listened to mine every week. But listen to a podcast this weekend. And they were talking about social media. And one of the podcast hosts was somebody who's one of the founders of Instagram. And he said, look, when, back in the heyday of social media, everybody had a social media platform. And there was a whole bunch of them. And then the cleansing happened and there was only a few winners that were left. And so that is an unfortunate reality of market cycles and of business cycles. And so you have to understand that. What you also have to understand is, where do you personally fit into the current cycle? What is your business model? Who are your clients and how are they going to be impacted? Not just how you're impacted, but you got to think ahead about how your clients are going to be impacted. Sometimes heading into a recession or preparing for a shift in the market means you have to get defensive. You have to pull back. You have to shift your strategy when it comes to marketing, when it comes to expenses. Other times, you have to be super, super aggressive. You have to take advantage of opportunity. I'm going to give you some examples here. I've had some clients of mine who run trucking companies, and I see people right now, the trucking industry is suffering. A lot of my trucking clients are saying, hey, things are tough. I've pulled back. I've sold some equipment. I've laid some people off. I'm trying to survive. Other ones are in the similar boat, but they're like, look, I pulled out. Like, I'm done. Trucking it's not worth it anymore. I'm shifting gears into a different industry. Still, other people in the trucking industry are like, John, how do I get cash? Where do I get money from? Not to survive, but to grow. They see the opportunity. They see the fact that, unfortunately, a lot of their peers are going out of business. And those peers that are going out of business have good equipment that needs to get sold. And so you have the opportunity to pick up that equipment. Now, you're not wishing ill will on your peers. You're not hoping that they go out of business. The truth is they are. And that's none of your doing. That's none of your fault. But you have the wherewithal, the financial means to pick up their pieces and grow your business. So I've got some business owners that in trucking that are saying, John, how do I get my hands on more cash? How do I get my hands on capital necessary to buy this equipment, because I can come out the other side of this significantly better? Warren Buffett's saying is, I am scared when others are greedy, and I'm greedy when others are scared. That is the thinking behind this anti-cyclical idea. Okay. In my industry, we have been going in the mortgage industry for the last 3 years through a recession. Now, what's funny is we are anti-cyclical overall because housing, and this is an important thing I'm going to talk about in the second half about what housing does during recessions, but housing in general has been very, very strong up through 2022. And it got strongest in 2020 and 2021 when rates were super low. And so we had, when everybody else was pulling back and COVID happened and everybody was shutting down, we were growing. And then when COVID was over and rates started going up and inflation became a problem, we were shrinking. And so we're anti-cyclical, but within that cycle, my industry has been in a rough time. We've lost a lot of loan officers. We've lost a lot of real estate agents. There's been nowhere near enough transactions to sustain the number of people that are in my industry. Yet I doubled down. I started doing things like this podcast and other things that I've done to help grow my reach, figuring a lot of my peers are shrinking. They're afraid. And when they're afraid, I'm courageous. When they're courageous, I'm afraid. Okay. I want to be thinking the opposite of them a little bit, because when everything is rosy and everything is, oh my gosh, it's golden, you can do no wrong, everybody has the Midas touch. That's when things often crash. That's when you often have the biggest issues, is when everybody thinks things are fast and easy, they become a big problem. And it becomes an issue where what you thought was true didn't have the underlying foundation to sustain it long term. It becomes irrational exuberance, is a term that the Fed had talked about. Alan Greenspan about 20 years ago talked about irrational exuberance. Everybody is buying homes because everybody's buying homes, and prices are going up on homes, and you can't lose money on homes. Well, that's only takes you so far. So when people are being irrational and super excited about something, that's not the time to jump in. But when people are fearful, that might be the right time to jump in. You have to decide for yourself, is this the right time or is it not? That is a personal decision. Sometimes you have to shrink back. Now, I told you that I grew my business over the last 3 years, but the truth is I had to shrink first. I had too much staff. I had to make tough decisions early in that process, and a lot of my peers didn't. And so part of it is when you own a business, this is going to sound horrible, okay? But when you own a business, you recognize that you will always be hiring, firing, and laying people off. There's no way around being in one of those three situations. And whether you're hiring, firing, or laying people off, the truth is that is a normal part of the process. I had to do that. That was rough. That was very rough. I had to lay off some very, very long-term employees because I knew I wouldn't survive if I didn't. Financially, I didn't have the money coming in. But when I shrunk, I got small enough that I could survive on fewer transactions. And now that I was at that point where I could survive on fewer transactions, if I just got one more than that minimum survival number, now I was able to reinvest that back into the business. Now I was able to spend more money on marketing and spend more money on building opportunities and searching for niche markets that my competitors were shrinking and afraid to do because they were just convinced, like Chicken Little, the sky was falling. And so when you look at the potential for a market shift, whether you're in the middle of it, I also was taught a long time ago by a coach that you're always in one of three phases in your business. Either you're in a storm, you're coming out of a storm, or you're about to head into a storm. That's it. One of three things. You're in a storm right now. Things are bad. We're in rough shape. I don't know what I'm going to do in the middle of a storm. Picture yourself as a boat in the middle of the ocean. You're in the middle of a storm, huge swells, rain, lightning, the boat's rocking all over the place. You're not sure if the boat's going to be able to handle it. You are in the middle of the storm. Then dawn breaks and the clouds part and the sky starts to open up, and you have an opportunity to see the benefit of of the storm ending. And you're looking at that saying, okay, I'm coming out of a storm. How do I adjust? What do I repair? What do I have to do to make sure that that my boat is seaworthy at this point? Because we just went through a major storm. But now that you're coming out of the storm and you're out of it, and you're saying, oh my gosh, everything is great. The seas are calm. The skies are blue. The sun is shining. Just recognize there's another storm waiting for you somewhere. Now, it doesn't mean you live in paranoia or fear, but you live in the reality that there are just more storms ahead. There's times ahead that you're going to have to lay people off. There's times ahead that you might have to fire somebody because they did something that was not appropriate. You have to recognize in business, it's a cycle, and you're somewhere within that continuum all the time. Oh, okay. So I want to shift gears now. I'm going to pause really quickly for a quick commercial break, and then you can come back and I will talk about how recessions impact housing and how to look at a recession when it comes to your real estate portfolio. So hang tight. I'll be back with you in just 1 second. Hello, friends. Just wanted to interrupt our podcast really quickly to talk to you about owning properties in an LLC. It is a phenomenal strategy to protect your assets against any type of a claim that comes from a property that you own. The problem is conventional financing doesn't allow it. So most people who own investment properties have bought them either in their personal name or in a family trust, which exposes you and your family to liability and lawsuits because you're the owner of the investment property. And if something happens there, they can come after you. You need to talk to your attorney about the pros and cons of using an LLC. You need to talk to your tax guy about the pros and cons of using an LLC. But you for sure need to know about the option that I have available that will allow you to purchase investment properties in an LLC instead of being in your personal name, because it is a game changer in protecting you and your family's financial future. Hello, friends. Welcome back. I want to talk now about how recessions impact the housing market. Now, one of the biggest misconceptions is that recessions cause housing prices to go down. That is the first thing I want to dispel. Recessions do not cause housing prices to go down. As a matter of fact, if you're watching on Spotify or YouTube, you can see the visual that I'm pulling up right now. This is the median home price of homes going back to 1965. And these gray bars here are recessions. And so for those of you that are listening, I'll explain it to you so you don't have to jump off. But here's the first recession in this timeline started in 1970. The average home price was $23,900. It ended 1971. It was $24,300. Housing prices ended the recession higher than they started. Here, the next recession started in 1973. Average home price was 34 grand. Don't you wish you could go back there and buy a home? I do. All right, 1973. Average home price was $34,000. That recession lasted until the middle of 1975. Average home price had gone up to 39 grand. Here we are, a recession in 1980. Prices started at 63.7, ended at 64.9. Here we are in 1981. Prices started at 69,200, ended at 71,600. Here we are in 1990. Prices started at $117,000, ended at $119,900. But if you're watching, what you notice is after the recession, prices continue going up. So during the recession, you have a little bit of a drop in prices at the beginning of a recession, and then they go up. And every single recession, we saw that. Even here in 2001, this one, we had 179,000 was the average price. As we were finishing the recession, it was 171, but immediately afterwards, like literally within 3 months after, it popped up to 188. So that one officially, prices were a little bit lower at the end of the recession, but it was only not even a year, barely 9 months of a recession, and 1 year later they were up to $188,000. So the one that we lost value on was the recession that happened in 2008. So average home price started at $233,900 first quarter of 2008. By the end of that recession, which ended in the third quarter of 2009, prices were down to $214,000. But if we look at the peak heading into before the recession, the peak was $257,400. We were back up above that peak by 2013. So you're talking about 6 years from peak to peak, not peak to trough, but from peak to peak. It was only 6 years, and that was the single largest recession that caused housing prices to drop, which is actually the wrong way to say it. It was the housing market that caused the recession that caused housing prices to drop. So it was bad mortgages that was done. It is the biggest anchor in our minds when we think about recessions and we think about the fact that, hey, we are dealing with what could be a recession right now. Maybe it may not be. We have the jobs report that came out last month. Again, I'm reporting this late August of 2025. You'll know more by the time you're watching this probably, but actually you won't, because hopefully you're watching it tomorrow. But the fact is that the jobs report came out, significantly lower number of jobs. There's a lot of concern about the job market. Jobs really is the definition of the concern of a recession. It's not the definition of a recession, but it's the concern. The concern is if we're in a recession, we're going to lose jobs. And if we lose jobs, then those people don't have money, which means they're not going to spend the money, which is going to deepen the recession, and it becomes a vicious cycle. And so the Fed is worried about jobs, and the Fed is focused on jobs. And that's a lot of what they're thinking about when they think about whether they're going to lower interest rates or raise interest rates is jobs and inflation. Those are the only two things the Fed cares about. But for you as an investor, you need to look at this as an opportunity. I have some clients that are purchasing homes right now. I have a client right now purchasing a home outside of Austin, Texas. It is a brand new home that is listed on the market for $320,000, and they are picking it up for mid 250s. Okay, so they're getting literally a $60,000 price drop, 50 something $1,000 price drop over where the price had been. And so you have to look at that and say, I want to see an opportunity for future growth. And the fact that you have a $50,000 price reduction means that there's $50,000 right there that you have as likely increase when the market turns around. You just have to be able to ride out the market. And so when you think about recessions, do not think about, oh my gosh, recessions mean that prices are going to fall. Because here's why. Here's why house prices don't fall in a recession. Because the Fed lowers interest rates during recessions. And when interest rates go down, that makes it cheaper to buy homes and ultimately leads to house prices going up. It's that simple. The Fed is trying to get us out of the recession. The number one tool the Fed has to tweak the economy is interest rates. And so when we are in a recession, the Fed is going to do everything they can to get us out of the recession. Because the cycle I just talked about, they're afraid that, hey, if businesses aren't producing as much goods and services, they're going to lay people off. They lay people off, and those people don't have the money to put back into the economy, which means they're going to buy less goods and services, and now businesses need to lay more people off. And so what the Fed does is they lower interest rates. What does that do? Well, directly it spurs the housing market, which means that you've got lenders, you've got real estate, you've got title companies, you've got construction workers that are now getting jobs because the housing market is taking off. The second thing that it does is it gives people more free rein to spend some money because the credit card interest rates went down, and it gives businesses more free rein to invest in their business because the cost of investing has gone down because interest rates are lower. And so they might say, hey, it might be a bad time in the market right now, but I can see my business growing over the next 10 years if I build this plant. Well, now's a good time to build the plant because I'm getting tax incentives and low interest rates from the government. And so the government is trying to do all of those things to spur the economy back to growth. That's the key. And so when they do that, they're lowering interest rates. And when that happens, historically, the housing prices go up. The 2008 market crash was the anomaly. Why? Because housing caused that crash. It wasn't the recession that caused housing prices to fall. It was the housing market and bad mortgages that caused the recession. So it is cause and effect. It's a different set of circumstances. The other thing that I will remind you that I hear people say all the time, John, how do we know that this isn't going to end up like we did in 2008? You didn't expect in 2008 it was going to be as bad as it was. You're right. I didn't expect in 2008 it was going to be as bad as it was. But in hindsight, in 2008, the first wave feels like this wave, feels exactly the same. There are people who are losing their jobs and can't make their payment. There's people who bought with small down payments that now can't refinance and can't sell, so they have to short sell or foreclose on the property. We're dealing with some of that right now. But what we're not going to deal with was phases 2, 3, 4, 5, 6. That was all about, in 2008, people who had adjustable rate mortgages. They could afford their payment that they had today just fine. They didn't lose their job. They could afford their monthly payment, but their payment was about to go up. Their interest rate was increasing because they did not have a fixed mortgage payment. They did not have a fixed mortgage rate. And so that payment going up caused them to say, you know what? I can't afford this payment. I need to refinance. The bank said you can't refinance because your neighbor lost their job and they sold their house for $20,000 less than what you guys paid for it originally. You're now underwater. You don't have the equity to sell. And so a lot of people say, oh my gosh, everybody walked away from their homes in 2008 because they were underwater. I don't agree. They walked away from their homes because they couldn't get their payment under control. Some people walked away saying, what's the point? I'm underwater. Well, if they could have held out 5 or 6 years, they'd be in a much, much better shape. But most of the people, they loved their home. It's your home. It's not an investment. It is your home. And so you are in a position where you can afford the payment today because you're in a fixed interest rate. Your monthly payment's not going to skyrocket after a year or two. Now, there are some people who did temporary buy downs in the last few years, which means their rate, they knew what the step up was going to be, And for some of them, they counted on refinancing. They bought the home in 2024. They got a 2-year temporary buy down that's going to last through 2026. And they're counting on refinancing because they really can't afford the normal payment. Shame on that loan officer for getting them into that loan. But the truth is, it happens. And the truth is, I blame the consumer more than I blame the loan officer. I do say shame on the loan officer because they should have made it clear to the client, you better be able to afford the payment long term. But I also look at the reality that I'm not your conscience. Once I make it clear to you what your consequences are of your decision, it's your decision. I'm not going to refuse to help you simply because I don't agree with your decision, because if I did that, you'd go to somebody else anyway and get it done. So at least I know I'm telling you the truth. But that consumer made that decision expecting to be able to refinance. Now that prices are starting to drop some of them won't be able to refinance. Some of them won't be able to afford that monthly payment. Some of them are going to lose their home. But that's the exception, not the norm. In 2008, that was the norm. So no, I don't expect a significant price drop. I don't know how quickly prices are coming back, but in a recession, recognize, and we're not in a recession yet. We may not get into one in this year, but the fact of the matter is, at some point, one is coming. And recessions do not mean lower home prices. They often mean opportunity. So look at it as an opportunity as the market falls to say, hey, how can I shift my investment strategy? Maybe I sell a property and do a 1031 exchange into something else. You've got to think about opportunity. Recessions equal opportunity if you look at it from the right perspective. Thanks so much for listening, everybody. Hope you had an enjoyable episode and that it really helped you to think about things a little bit different. Please reach out if you have any questions about anything at all. Please share this podcast with anybody you think that would find value from it. And if this is your first time listening, please subscribe. I'd love the opportunity to continue to share with you my thoughts on how to go from profits to properties. Thanks, everybody, and have a great day. Bye-bye.